Welcome to CFO Chat. This is a platform where we speak to the chief financial officers of various companies based on major developments happening in the market. And Family Bank is going to the market for Tier 2 debt through a bond seeking to raise as much as 8 billion. The first tranche is about 4 billion shillings. We are privileged to have the CFO with us. Steve, welcome on set.
Thank you very much for having me on the set today.
I looked at the breakdown of the details you issued yesterday, and one thing struck me, 13% in yield. And I thought to myself, you surely could have gotten cheaper debt elsewhere. I mean, we have seen Tier 1 banks going to DFIs and mobilizing. Granted, it's greenback denominated, but clearly it's cheaper debt. Don't you think you've left money on the table on this one?
Yes, so thank you for that question. And, just to give a brief explanation of what exactly we are looking out for in the market. So what you're looking out for is Tier 2 capital, which is subordinated debt, which means that it will be qualifying as part of our capital. So the best comparison for the cost that you're getting from the market at 13% would be to have asked ourselves, so if we needed to raise capital, so we can either do equity or the Tier 2 capital that you're doing today. From an equity perspective, the return that the shareholders would be asking as a return on their equity would be anywhere between 18 to, let's say, 22%. If you're then getting a capital, even from a debt perspective, which is then much lower than the return that the shareholders would be asking for at the high 20s, then you'll not have left money on the table. And then just to explain, so there are also other forms of debt, that's senior debt. And if you look at what most of the financial institutions have then been tapping from the DFIs have been senior debt. So senior debt is much cheaper. It amortizes pretty much on an annual or on a semi-annual basis. But the debt that you're looking out for in the market will only mature after 5.5 years. So we are asking for investors for 5.5 years money, which will only pay after the full maturity. And therefore, you then need to give the investors a decent return. And then just also to add on to that, if you then look at, we're getting it at 13%. If you look at what the sovereign is paying, that's the government of Kenya, for 5 to 6 years government bonds. So the government is paying anywhere between 11.25 to 11.5%. So the
premium is not too much.
That you're giving is pretty much anywhere between 1.5 and 1.75%. So we do believe that the debt is fairly priced for what you're in the market looking out for.
Good points you're raising there. Another thing which stood out for me is the sequencing, and this is what I mean by it. Family Bank retired its debt 2 months ago, the 5-year 2 billion shillings debt. And 2 months later, you're back into the market. When I looked at your balance sheet, I thought you would have remained deleveraged for a bit of a while, even just to send a signal that, hey, from a refinancing risk standpoint, we are well placed. I thought you came in a bit too soon.
Not quite. So what we had in mind when we were initially planning to retire the debt and come back for additional debt was then to say, so one, we needed to keep the promise that the bank made to the debt investors from the initial issue that the debt will be payable on maturity, which was in April 2021. And we didn't want a situation where, so investors would then start second-guessing the bank if, for instance, we sought a refinancing of the same debt. By that, say, going back to the investors and saying, we like to extend the maturity for this debt as opposed to paying you back the principal. So we wanted to have that confidence with our investors that, yes, the bank has kept their promise, so the bank is in a position to use its own internal resources to retire the debt. But even as we did that, at the back of our minds, we knew and we had the plans for the 8 billion public issue, which we are now in the market for. And looking at, what exactly would we want to do with the 4 billion that we'd be raising as a first tranche. So we'd like to continue strengthening our balance sheet. If you look at the last 3 years, that's 2018 to 2020, and even in quarter one, so the bank has experienced tremendous growth. And from a capital perspective, so for as long as you're growing, let's say your loan book, which is part of your risky assets, then you need more capital to continue supporting that growth. And that's what the extra 2 billion that you're tapping into the market will allow us to continue growing. Then two, would also want to invest in a long-term way in more advanced and more modern IT infrastructure. So we also do have plans to fully convert the bank into a digital bank. And for all those investments, you then need long-term funds or capital to actualize that. So in a nutshell, what you're then saying is that, yes, so the sequencing was planned for, so we didn't want to refinance the debt. And we are quite confident that, so having had a track record of taking debt from the market and paying it on time, not just the principal, but also the interest maturities that were coming up even before the principal maturity, gives the investors the right confidence to then take a second bet on Family Bank.
Steve, another reason why I looked at the issuance and I thought the timing was a bit curious is this. When I look at your Q1 numbers, and Q1 numbers across the banking sector, many banks were very conservative in growth of their loan book. And when I look at the Family Bank one, from a prudential requirement standpoint, you are not in a position where I would think, oh, these guys urgently need capital. So I'm trying to make sense of why at this particular time. Granted, you've said, the digital transformation, but from an on-lending standpoint, and considering the risk profile out here right now, there isn't much urgency, don't you think?
Yeah, I think you could say so, but again, just to look at it and say, so one, and also just to confirm what you said, yes, so even after retiring the debt, we're still quite compliant from both liquidity and capital ratios, so whether you're then looking at the core capital or the total capital. So however, if you're to then look at, say, what's our plans today, so we currently executing our 2020 to 2024 strategy. And at the back of that strategy, we do expect that the balance sheet will continue growing. And if you're then looking at funding a balance sheet, so you don't fund a balance sheet under distress. Rather, you don't fund your balance sheet when time is running out on you. And therefore, from a planning perspective then, so we then needed to start funding that balance sheet by looking back and saying, over this 2020 to 2024 time horizon, we need 8 billion in Tier 2 capital. And our first tranche is 4 billion. And then in terms of deployment, you're then saying, yes, so one, in the interim for the first tranche, we will improve our IT infrastructure, we will start investing in a fully digital bank, and then two, we will continue strengthening our balance sheet. And then when it then comes to, say, for instance, the second tranche, that's when we then start thinking about, what are the inorganic growth options available, whether in this market or outside the Kenyan market. And those inorganic growth opportunities could either be in fintechs or even in other, banks, same size as Family Bank, or let's say slightly smaller than Family Bank. So it's purely out of a long-term planning. And we also don't want to get to a situation where the balance sheet growth is faster than you can support it from capital. So we then needed to plan ahead.
Steve, I have to ask you this question. Did the retiring of EABL's bond have anything to do with this issuance? And why I ask that is this. EABL announces we are taking an early retirement of our debt, and the next week Family Bank is in the market. So if I'm a fund manager, and I was wondering, EABL has thrown at me liquidity I didn't anticipate. Where do I deploy this capital? Then the next week, Family Bank is giving me an opportunity. Was that a trigger for you guys?
No, it wasn't quite a trigger. It's purely a coincidence. So if you then look at, so what processes do you then have to go through before you, let's say, get the Capital Markets Authority to issue a listed instrument? So you need to appoint transaction advisors, get an information memorandum in order, get an objection from Central Bank of Kenya, get the approval from a Capital Markets Authority. So all that takes quite a long time. So it took us, say, between 2 to 3 months to get all that ready and eventually get the approval. So EABL's redemption of the bonds is purely a coincidence. I think it is a good thing for us for a few reasons. I think the first reason is that it brings or it goes ahead to build confidence in the bond market that within these years, so Family Bank was able to retire their bonds successfully. And even East African Breweries is also retiring their bonds. So investors already have confidence that once you put your money in the stock market, it can actually come back. I think the second advantage for us is that we do believe and do hope that so the investors in the EABL bond who had not anticipated this liquidity will then find a home for their liquidity in the Family Bank's bond. And we do hope that, as a result of that, then the success probability of our issue will even be much higher than it was before this redemption came into the picture.
Speaking about the success probability, that's a good point you've raised because we all understand the corporate bond market is still reeling from the toxicity of the Chase and Imperial Bank issuances. One, Aecon came to the market. They had to come with a guarantee to nail an 85% subscription. Centum Real Estate came to the market. They had to come with a sinking fund to be ensured they mobilize the kind of subscription they did. What strategy do you have in terms of the appetite for your bond?
Yes, so I think looking at Family Bank, I think our biggest foundation, which also gave us the confidence to go back to the market to seek investors for the 5.5 year money, would be one to say, so if you look at the Family Bank's credit history, so one, we were then able to retire the bond on time. We had always been honoring our, obligations on interest payments. So that's quite an impressive credit history. Then two, if you look at, say, the past 3 years, up to and including Q1, so the bank has been on a growth path. So it has been on a recovery path. And not just a recovery, but a recovery which has also been anchored on, strong fundamentals. If you look at our 2020 results, that's last year's results, notwithstanding the shocks that came into the market. So we didn't quite register a drop in our earnings compared to 2019. We've continued growing our balance sheet. If you look at, say, quarter-on-quarter growth between last year and this year, I think all parameters have experienced positive growth from total assets, loan book, deposits. And this is purely out of we having the capability to identify opportunities within the market that you're playing in and then taking advantage of those opportunities. From a governance perspective, again, Family Bank is regulated by Central Bank of Kenya. So we do have to comply with regulatory prudential ratios, so whether from foreign currency exposure, liquidity, or even from a capital adequacy requirements. And both the management and the board also has to go through a central bank process of vetting. So I think while it may not really be in the form of a guarantee that you can, let's say, get from, say, Africa Guarantee Fund or Africa Trade Insurance Agency, that in itself, so being a highly regulated entity with higher governance standards that you have to comply with, already gives a guarantee to the investors that so this business is being run in a sustainable manner. Again, for you to then have a listed instrument at the Nairobi Securities Exchange, there are also corporate governance requirements that you have to comply with under CMA. We have been complying with those requirements up to the maturity of our previous issue, and it is our wish to continue complying with those corporate governance requirements. So we do believe that at the back of that, without a sinking fund or without a guarantee, then the investors will still get the comfort and put their money in the bank.
And how starkly different is the issuance pre-Imperial and Chase versus post-Imperial and Chase from a disclosure standpoint, now that you've had the opportunity to go into the market at both times?
Yeah, sure. So the disclosure requirements, I would say they are more so they are more stringent. So today CMA requires disclosures or declarations, for instance, from directors that they will continue complying with the corporate governance guidelines issued by Capital Markets Authority. So today, for a regulated institutions as ourselves, before CMA again makes that approval, you also then need to get a no objection letter from the regulator, that's Central Bank of Kenya. So the reporting accountant and the auditor also have to make a declaration that, to the best of his knowledge and belief, the financial statements and the information memorandum contains true and fair statements with regard to the bank. And at management level, yes, so senior management also have to make a declaration that there is truth and fairness in what is being presented to investors in the form of an information memorandum. You'll also notice that there are also requirements with respect to separation between an issuer and who will, let's say, be a receiving bank. So CMA is then moving to a situation where if you're an issuer, whether a bank or an unbanked financial institution, then you're not the receiver of those funds. So just then to make sure that you'll only receive the funds when the issue is successful, and just to give confidence to the investors that their money will only be applied for the uses to which the information memorandum has spoken about. Yeah.
Many players in the market have been worried about the dissipation of investment-grade corporate bonds, and I'll tell you why. Because we saw an early retirement from Centum, we saw an early retirement from EABL. Of course, earlier this year, you guys, retired your debt. Do you think the corporate bond market is now bouncing back?
I do believe that the corporate bond market is bouncing back. So just to speak about, say, for instance, the Centum area retirement, I think the disclosure Centum made at the time was that they were just out of a transaction that's disposing of Almasi beverages, so the company had enough liquidity, and then in terms of the uses of funds, it was prudent for them at the time to retire their bond. But if you then look at, have they been in the market recently? Yes, so Centum and Acorn have been in the market within a span of maybe less than a year ago. Which then still means that the capital market still remains an avenue through which companies can then raise funds. If you then look at Family Bank itself, so we have been in the market. We had a bond, it matured, and we were in a position to pay that bond, which again must have boosted the confidence. So if you look at EABL again, EABL will be maturing. Will be paying off their bonds, say, 9 months to 1 year earlier than anticipated. I think the fact that they are in a position to pay back investors' money, that should also boost investors' confidence. And again, if you look at most insurances, so the lawyers have an option of, let's say, an early redemption. And that early redemption is left open for the company or for the issuing entity to figure out, if at some point in time then I have other sources of liquidity, I can then substitute this debt for those sources of liquidity. So in a nutshell, I would say, the Capital Markets Authority generally, both on equity side and on the bond market, is bouncing back. If you then look at the alternative investment segment where companies are coming in for incubation at Ibuka, I think we've also had maybe more than 3 companies this year getting into the Ibuka incubation program, and therefore we're quite optimistic that the market is bouncing back, both from equities, debt, and even from an incubation perspective.
I see. As we wrap up, Steve, I think you're going to the market at a very tricky time. And why I say that is because the budget estimates have already signaled to the market that the Treasury will be going into the market for potentially 600 billion of domestic financing. Essentially, this risks crowding you out, essentially, from the market. Do you consider this a significant risk?
Yeah, so it is a risk, but I wouldn't consider it as a significant risk. I think for us, as I explained earlier, from a pricing risk perspective, I think we already factored in that, and that's why we are then saying that, similar instruments from the government would be, let's say, at between 11.25 to 11.5%, and you're then saying, yeah, so we then needed to give a premium to investors. So therefore, I wouldn't say that is within our offer opening and our offer closing, the domestic borrowing intentions of the government will highly likely affect our success when it then, as we are allowed now raising the 4 billion shillings. However, I do think that in the long run and to the entire private sector, access to credit, higher appetite for government to borrow internally would always then have the obvious crowding out effects. So because if you then look at the instruments being offered by the government, they are coming in at rather, reasonable yields, and, the providers of credits would then predisposed to almost make a decision between, okay, do I lend this money to my customers or do I invest in government securities? But again, having said that, if you then, let's say, look at the recent releases from Central Bank of Kenya in terms of, say, the private sector credit growth, it has been on an upward trend. If you look at, say, a number of institutions, even from their quarter one results, you can almost see a growth in the loan book between December 2020 to quarter one of 2021. So what that again means is that there are still bankable opportunities which are being financed by financial institutions, and we are at a point where, apart from what a bank would be holding as excess funds, much of the rest of the funds are then being directed to providing credit to private sector.
Family Bank has been quite active in the capital markets on the debt side. On the equity side, are we foreseeing an IMPO in the medium term, possibly?
Yeah, so thanks for that question. I think the straight answer to that would be yes, with the rider at the right time. So because when you then look at, let's say, a listing, so a listing would obviously then provide an avenue for current shareholders or new shareholders to, for current shareholders to get value for their shares or realize a market value for their shares, or even for new investors who then like to invest in Family Bank shares to then have an avenue through which they can then get those shares. I think in the short run, so it doesn't seem like the timing is right. If you look at, the price to book multiples, which most of the quoted shares are trading at today, a number of them are highly discounted. So we've seen, discussions in the market where some companies are even going out in the market and saying we'd like to buy back our shares on the basis that when they do their own valuations, so they do feel that their companies are devalued or undervalued as far as the market is concerned. So we have those as long-term plans, so we will keep checking the market for the right timing, then just to then make sure that we eventually give the best market value for our shareholders.